Welcome to the deep dive. For so many of us, trying to make investment decisions can feel a bit like,
Yeah.
well, guesswork, right? Maybe based on instinct
Love
or just what's buzzing in the news.
Absolutely. It feels overwhelming sometimes.
Exactly.
Yeah.
So our mission today is really to give you a practical shortcut. We want to help you understand a company's balance sheet, even if you don't have an accounting degree.
Yeah, get past the jargon.
Right. And this isn't secret stuff. It's all from publicly available, audited financial statements. This knowledge can genuinely help you spot those potentially strong stocks and, importantly, avoid some hidden risks. Okay, let's unpack this.
Let's do it.
So, first things first. If you want to know if a company has actually performed well in the past, where do you start on that balance sheet? What are you looking for?
Great question. You start with the absolute basics, but you need a critical eye. Assets versus liabilities. Total assets should be greater than total liabilities,
So
obviously.
that's solvency, right?
That's solvency, yeah. But we're looking for more than just not being bankrupt. We're looking for real financial strength, a solid foundation that can handle bumps in the road. It's fundamental.
Okay, makes sense. And building on that strength, I guess that leads us to shareholder equity growth.
Precisely. If that equity number is consistently climbing over time, it suggests the company isn't just paying out all its profits as dividends. It's reinvesting back into itself, building value internally.
And that connects to return on equity, or ROE, doesn't it? This one gets talked about a lot.
It does, and for good reason. Think of it like a grade for management. Net profit divided by shareholder equity. Are they using the capital effectively?
So what's a good number there?
Well, consistency is key, but generally if you see a consistent ROE, maybe above 12% year after year, that's often a sign they're pretty good at turning shareholder money into more profit.
Not just a one-off spike.
Exactly. A single good year doesn't tell you much. Sustained high ROE, even when the economy's a bit shaky, that's where you often find the really solid businesses. It's fascinating how these sort of simple ratios can paint such a clear picture of core financial health.
Okay, so that gives us a handle on the past. But investing is all about the future, right? So what clues does the balance sheet give us about where a company might be heading?
Right, we need to shift gears from the rearview mirror to looking ahead. One big indicator is capital expenditure, CapEx.
Spending money to make money, basically.
Kind of, yeah. It shows if the company's actually investing in things like new equipment, technology, expanding, stuff that fuels future growth. It's a signal about management's confidence in their plans.
And what about cash? You hear about companies having big cash piles.
Yeah, cash and cash equivalents. It's good to have cash, definitely. It gives you flexibility maybe for acquisitions, R&D, or just surviving a downturn.
But can there be too much?
Well, potentially. If a company has enormous amounts of cash just sitting there, earning very little, it might make you wonder if they have enough good ideas or investment opportunities. Is it just idle cash? That can be a drag.
Interesting point. And then there's the whole share buybacks versus dilution thing.
Yes. Buybacks, where the company buys its own stock back, can be a positive sign. It reduces the number of shares out there, potentially boosts the share price, and often signals management thinks the stock is undervalued.
But the opposite, dilution. That's not so good.
Generally, no. Dilution is when they issue new shares. This means your ownership slice gets smaller. Sometimes it's necessary for funding, but consistent dilution can be a bit of a red flag. You have to ask why they keep needing to issue more stock.
So these forward-looking bits, they're really clues about strategy and confidence.
Exactly. If you connect the dots, you're not just seeing numbers. You're seeing signs of management's vision, their commitment, or maybe a lack thereof.
It really does feel like playing detective sometimes. You've got the obvious clues, but then you need to look for the hidden traps.
You absolutely do, because not everything is straightforward. You need to dig a bit deeper.
So what are some of those hidden pitfalls we should watch out for?
Okay, one key thing is receivables as a percentage of revenue. Are their sales going up, but the amount of money owed to them by customers is going up even faster?
Like they're making sales but struggling to collect the cash.
Precisely. It could mean they're having trouble getting paid, or maybe they're loosening credit terms too much just to book revenue.
Yeah.
It's a potential warning sign about cash flow.
Okay, that makes sense. What else?
You absolutely have to check the notes section, the footnotes to the financial statements. That's where you find contingent liabilities.
Things like lawsuits or potential fines.
Exactly. Stuff that isn't a definite liability yet, but could become a big problem down the line. It might not be on the main balance sheet page, but ignoring the notes is a big mistake.
Got it. Check the fine print. Anything else?
Yeah, one more. Watch out for unusual asset sales. Sometimes selling assets is strategic, part of normal business. But if a company is constantly selling off bits and pieces, especially significant parts, you'd have to ask, are they doing this to generate needed cash because the core business isn't performing well?
So it might signal underlying problems.
It could. It just raises that important question. Are you looking only at the surface measures, or are you really digging into what's going on behind the scenes, checking those trends, reading those footnotes?
And that really brings us full circle. That's the power we wanted to unlock in this deep dive. By getting a practical handle on the balance sheet, you're moving beyond guesswork.
You're making more informed choices.
Exactly. You're better equipped to spot those potential opportunities, or just as importantly, those hidden risks. So here's a thought to leave you with.
Okay.
Next time you look at a company, maybe pick just one of these areas we talked about, ROE, CapEx, receivables, whatever. How might focusing on that one insight change your whole perspective on its true value?